Hello and welcome to lecture for chapter 2, Analyzing and Recording Transactions. Remember in chapter 1, we already started analyzing and recording transactions. We just did things as negatives and positives, especially in that homework. You got to actually practice doing it. However, in accounting, we don't really use negatives and positives because they can get a little confusing if you use negatives and positives. Believe it or not, credits and debits are less confusing. I know they sound a little daunting, but they're not too bad, and we'll get into them now in chapter 2. So let's go through kind of what the process is for accounting. First of all, what we do is we analyze transactions from what's called source documents. And some of this is historical. In real practice today, a lot of things are computerized, so you may not be looking at actual physical documents. But suffice it to say that back in the day, if you were in the accounting department or an accountant for a company, you would get some source documents like bills, canceled checks, all sorts of things that show the company has either spent money or received money, and some sort of explanation as to why, so that you could properly record that transaction. And some didn't necessarily include cash. Some include just purchasing of inventory or goods or supplies or equipment on credit, but you would still get some sort of a document like an invoice or a bill, which would show a financial transaction that the company has partaken in and impacts their financials in some way. So that'd be step one. Next thing to do is, of course, record the relevant transactions. Anything that impacts the finances or financial well-being of the company is something that we need to record, and we would record that in a journal. Once we record things into a journal, we would then move down to step 3, and we would post or really move what we recorded into our general ledger accounts. And all that means, we're going to learn what ledger accounts are in this chapter, but every account, everything that we keep track of will have its own account. Like cash, for example, will have an account where we keep track of money coming in and money going out. Supplies will have its own account where we keep track of supplies that we have purchased and supplies that we have used up. And every single asset, every single liability, every single equity type account will have its own ledger account so that we can keep track of things properly. And finally, what we do is we prepare a trial balance, which shows the balance or how much is in each of the ledger accounts. And that's how we prepare our financial statements, and we can very clearly see what the financial well-being and status of a company is. So source documents, some examples are here for you. Like I said, I don't need for you to memorize any of these. Just be aware that these are the type of documents that we might see if we were an accounting department. But really, I won't test you on anything like that, and nothing that you need to memorize. So again, an account, of course, is just a record of increases and decreases in the specific asset, liability, equity, revenue, or expense account. Remember, equity has multiple types of accounts, right? Investments and withdrawals, and even revenue and expenses can specifically be under the equity umbrella. And the general ledger is really just a record that contains all of those specific type of accounts, and we'll go through some examples in just a moment here. Remember that asset accounts are going to be specific types of assets. Remember, assets are things that a company owns or controls, which will provide some future benefit to the company in the future, right? I doubled up on future there. Let's go through some examples together. So cash, very clearly, we all know it, we all have used it, and hopefully we all love it, right? We've had it. Once you have cash, you know that you own it and that it will benefit you in the future because you can purchase anything you want. We went over accounts receivable previously, right? This is where another company owes our company some money. So this is something that we own. We own a legal right to collect money or even services or products in the future, but it's something that someone owes us. It's called a receivable account, and it's something that we legally own that will provide us a future benefit. Notes receivable, we won't work too much with that, or maybe even not at all in this semester, but it's good for you to be aware that's the same thing. It's something that another company or entity or person owes our company, but it's insured by an actual note, meaning a long document that's written and somebody has signed saying that I actually owe you. You'll see things, see notes receivable more with mortgages and formal loans. Accounts receivable are more akin to a company who has regular customers and they just allow them to keep an account open without having to sign a promissory note every time they buy from us. Supplies, once again, these are small things. Office supplies are one example. In our lemonade stand example, it was lemons, cups, things like that we would use to make our products. Equipment is pretty self-explanatory. These are large, tangible things like pickup trucks or delivery trucks if we are a company that delivers things. Photocopiers, bulldozers, large, tangible objects that we actually use in our day-to-day operations. Buildings, I think we know what that is, and land, of course. These are things that a company can and usually do own, and of course will provide them some benefits in the future. Equipment, of course, will benefit us because it will help us do whatever it is we do. Buildings will give us a place to either house our offices or our manufacturing plant. And land, of course, we can do all sorts of good things with. So these are just examples of assets. And if we had any of these, so if we have equipment, our company will have specific equipment accounts. If we've got cash, which every company does, we will have a cash account. Some have multiple. In our examples, we will only use one. And every account receivable will have its own account. Now, prepaid accounts, it's something that we didn't go over, but is on that last slide. Prepaid accounts deals with, or prepaid expenses is another way to think of this, deals with when we spend cash for things that we generally think are expenses. But when we prepay for them, they actually become an asset. This goes back to what we spoke about before. When a company spends money, and follow along with me here, when a company spends money or takes on debt, remember, taking on debt is the same thing as spending money, right? If I go to the store and pay cash for a $100 shirt, I've spent money. If I put it on my credit card for $100, I've taken on debt, but it's the same thing, right? I've received a shirt and I either paid or owe money. Either way, it's the same effect. So when a company spends money or takes on debt, we need to ask ourselves, what is the company getting in return? Real important here. Is it something that we now own and will benefit the company in the future? Or is it something that has already been used up? That's the question I want you to ask yourself every time a company spends some cash or takes on debt. Now, if what we're getting in return is something that will benefit the company in the future, you know it's an asset that the company has received and we need to record an asset. If, on the other hand, we've spent cash or taken on debt and what we're receiving in exchange is something whose benefits have already been used up, then it's an expense and we need to record an expense specifically. So prepaid expenses or prepaid accounts, let me give you an example. If I'm paying the utility bill, let's say the electricity of our factory for last month, and it was $1,000. Our company has paid $1,000 cash, so our cash has been reduced, and we have incurred an expense, right, of $1,000. Because we've used up all that electricity, it helped us gain revenues last month. However, if our utility company came to us and said, hey, if you prepay us $9,000 right now, that will cover all of your electricity for next year. That would be an asset, right? If we went and gave them $9,000 cash, of course we would reduce our cash by $9,000, but we wouldn't incur an expense yet. What we've gotten is a $9,000 asset, right? Now the company, the electricity company, owes us $9,000 worth of electricity. And as we use up that electricity, we would then take an expense. So in the first month when we purchase it, $9,000 cash would have gone down, but we gained ourselves an asset. And we'll talk about how we incur the expense later. But for now, keep that in mind, okay? Always ask yourself the question, when the company spends cash or incurs debt, what are we getting in exchange? Something that's going to benefit us in the future, or have we already used up what we're paying for? And if we've used it up, it's an expense. If it's going to benefit us in the future, it's an asset. Real important concept that will drive a lot of the decisions and mean a lot of right or wrong answers for you in this semester. So please get comfortable with this concept of when the company spends money what are we getting in return? Ask yourself that question. Next, of course, are liability accounts. Some of the main ones that we will see, of course, and the main one is this accounts payable. Just like we had accounts receivable, accounts payable is basically the opposite. Whereas before, a company or another person owed our company money, an account payable is where we owe another company who we do business with regularly some sort of money or services. It can be services, it can be products. When I say monies, I mean something with a financial value. So, for example, let's say we sell, we're Walmart, and we sell all sorts of goods. We've got one supplier like Sunbeam who makes all sorts of household appliances, and every month we go pick up thousands of dollars worth of inventory from them, but our truck just goes, picks it up, and doesn't pay them, of course. They just send us a bill for what our truck picked up that time. That's our supplier. Whatever that bill is for is an account payable for us, right? We receive a bill for $20,000 this month. Well, we now have a payable. Until we actually pay that bill, it's a payable for us. It's a receivable for our supplier. Notes payable would be the same thing, but it's secured by a promissory note. Again, we won't work with that too much. Accrued liabilities and unearned revenue we'll get into a little bit in the future. Just keep those in mind for now, but they're a little complex and we will get into them in future chapters. And of course our equity accounts, remember owner's capital is investments. When our owners invest money into our company, that is what we now owe them. And it could be monies or goods, remember, cash or goods or even services. Any sort of investment that our owners make in our company is something that we would owe them. Anytime they withdraw from our company, that would of course reduce the amount that our company owes its owners. And revenues, remember, this is what we generate when we do whatever it is that our company does. But remember, we don't recognize revenue until it is earned. Doesn't matter if cash is received or not. As long as we have earned it, done our earning process, we then record revenue. And expenses, of course. Remember, this is that key and a little bit unusual concept. It's not when we spend money, right? It's when we use up some sort of value of our assets. So it might be when we spend cash, as long as what we're getting in exchange for cash is not an asset, as long as we have used up all the benefits of that cash. Again, that example of last month's utility bill, right? Or last month's phone bill. If we're spending cash for something like that, then yes, it's an expense right away because we've used up all the benefits. However, if we are prepaying, or if we're going out and buying ourselves a car or a truck that we're going to use in our operations, then no, it's not an expense. Not until we start using up the value of that truck or that asset would it be an expense. When we first spend it, it would be an asset, of course. But these are the different kinds of equity accounts. Now, real important, every company is going to have a chart of accounts. For every account, everything that we keep track of, it will have a separate account. And I know this is a really busy slide, but not much to it here. What you'll see here is generally the way companies do it is they'll number their accounts, and you don't have to know this numbering system, but usually in the 100s here, you'll see all the asset accounts that a company has. In the 200s, the next ones, of course, will be liability accounts, right? Your accounts payable and unearned revenue, which we'll get into later. Then, as we move into the 300s, we'll see our equity accounts, right? The owner investment and the owner withdrawals. 400s are our revenues, and the 600s are our expense accounts. These are just some examples, okay? Depending on the size of a company, it can have thousands, literally thousands of accounts in its general ledger. But this would be our general ledger. It would be made up of these accounts. And not to worry, in our class, in this course, all of our companies will have no more than 10, 15 accounts, not the thousands, because I just want you to understand how to use them, and that could, of course, be applied to far more complicated chapters. That should end this video. We'll now get into T accounts and individual accounts in the ledger. So let me back up one slide before we end here. If this is the general ledger, which shows all of the individual accounts, we'll now go into what each individual account looks like when we dive deeper.